Trust you are well. Welcome to this market update. I want to look at the daily chart. I think most of you know I trade off the 5 minute time frame, but 5 minute time frame is not that useful for an overall outlook for the week. We just take what comes as each day unfolds. But price action is price action. So I'm just going to have a look at 6 markets on the daily time frame, and they'll give you some ideas in terms of how to look at a lot more markets. You will see the markets that I've selected. I've got two indexes, DAX 30, I've got UK 100. I've also got two majors currencies, pound USD, and I've got the euro versus the dollar. I've got gold, and we'll look at a cross Aussie CAD right at the end. So let's get into it. What I'm going to do, I'm going to switch off my video. I get distracted by looking at myself. So I'm going to take that off. For the presentation, I'll come back and just say cheers at the end. All right. Okay. So this is DAX 30. And since price action is price action, you can use the insights that I'm going to be sharing with you on any other market. Doesn't matter what the market is. So here we have a bit of a view from January, but presently to where we are. This is what the market has been presenting us as far as DAX 30 is concerned. Now, what do you notice if you look from left to right? Well, okay, market has been going up nicely, came down, went sideways, went up, and there's been an attempt to go down. But one distinguishing factor in terms of what the chart is showing us, the biggest candles have occurred in June. And we have the second, or the two largest candles are occurring in June. We have two consecutive bear candles. We had two consecutive bear candles again the previous month here, and in April. Consecutive bear candles, but not trend candles. So I'm talking about trend candles, in other words, where the market was fully controlled by the bears, not with tails at the bottom. So as you look from left to right, the bears have not been strong this market. So the whole market has been bullish, right? If we start from where we were here to where we are now, it really is just a bull channel, okay? Pretty strong bull trend in here, bull back, bull breakout above here, failed to break out above the high that we had end of March, April. And then we started coming down. Now, as far as what to look out for in this coming week, as far as this market is concerned, if the bears are strong, then all we have with this past week's price action, as far as bears will be concerned, they're just thinking, well, it's just a pullback. We had decent enough two-bar reversal here with two strong bear candles by strong full candles closing on or near their low, with a nice breakout here, which really cleared nicely a lot of price action from the middle of May. And then last week's price action is a pullback. We didn't even get above or to test the high, of this last candle, in the previous week. So as far as bears are concerned, if any bears sold here, you should be holding your stop up here. You got to wait until you get a pullback and start to accelerate down. So bears are going to be hoping that, strong bears are going to defend this high. If you go above that, they're hoping for a failed breakout above that, so that these lower highs we have been getting will continue. So bears are really looking for acceleration down. Now, if the bears get that, and now we're talking, what decisions you need to make if you have been in the market. There is that breakout. Okay, there is a breakout, two strong bear candles, and you're hoping for a pullback. If the bears come in and start to sell off, I'm always looking for the first potential target as a measured move. You've probably heard me talk about measured moves a lot, and I think, and I'm hoping you're starting to use those, uh, you know, in trading. Every trader should be talking about, some basic things about price action. It all comes down to price action, whichever way you look at the market. So we should be thinking about, well, okay, if we break out beneath here, if this is a first leg, that's a pullback. How far would the bears want to go as an initial target? Well, the initial target would be a measured move, which would be taking out the low, of April. Now, whenever I see these big tails here, I'm very interested in who controlled the body. So the bears still control this, but then, nice enough reversal, a bit of a gap up here. So the bears want to get back close beneath that lowest close and take out even that low. So if you're looking to get in the market, if you're not already in, then wait to see if you get a decent enough signal, trend candle by the bears. If you get that on Monday here, then you can sell beneath that open that we get down here. And, more conservative stop is right up here, or you can put your stop above there. If you don't get that and you keep going sideways, then there is no bear case. If you're in the market, you need to tighten your stop. If you're not, just wait. Would you buy? I wouldn't be thinking of buying at the moment, until the bulls start to show strength. If this trading range price action continues into July and we start to see bullish strength, like we had here, then you can start to think of buying a little bit higher. You don't want to buy into this top of this trading range. But when you get three strong bull candles and they break out above that level, then you can buy. So only if this carries on going sideways, becomes a trading range, and we get bulls closing above it, then you would think of buying. Otherwise, bear candle, hopefully we get a bit of selling. If you don't get that, there's nothing to do. I mean, if you trade in the daily time frame, last week you really just have been sitting on your fingers. There's nothing to do here, unless you're scalping. But scalping on the daily time frame is a little bit tricky. UK 100. Now, the only time in this month that we've seen any bearish strength is this large outside candle. That one followed by that one. But otherwise, we are in a trading range for the month. And if you were to say to me, well, you're pressed, George, you have to take a trade. Which way do you want to go? I'm going to say, listen, buddy, I think I will step out of this one because it's a tight trading range. Nothing in here is telling me who is likely to have a chance. If we have the bulls breaking out above here and closing above here with a decent enough trend candle, in other words, not a doji, then I'll say, okay, I'll probably buy, knowing that breakout might fail above here or, might fail at these levels. Would I sell? I'm not going to do anything within this trading range. I'll have to see the bears coming down, closing beneath here quite strongly. So UK 100, if you trade this market from a price action perspective, going into Monday, there's nothing much to do. You're just going to have to wait, watch it, from the corner of your eyes. And, if you start to get something like this big outside candle, then a follow through, then you can say, okay, and I can think of buying. I can put my stop down here and then just hold it. But within the trading range, there is nothing to do with this particular market. Remember, this is a daily time frame. If you go down time frames, hourly, 15, 5 minutes, a different thing. I mean, of course, with the lower time frames, you will get opportunities to trade. Depending on how you trade, what your strategies are, there will always be something out of a basket of these six kind of markets. Pound, US dollar, let's look at some currency majors. Trading range, big trading range. Why would I say that? Well, if we just look, somewhere beginning of the year, somewhere within here, we are smack bang exactly where we started. Bulls went up, failed. Bears came down, failed. And bulls couldn't even get above the high that we've had so far, from the chart that I've shown. So bears are trying to take control of the market. Now, they had a chance, after these two candles. The only candle that really demonstrated strength, although they controlled that one, is this candle here that broke beneath the low of the month. They had a chance to put a follow-through candle after that breakout. They failed. Then they had a good resumption with this trend candle here. Very good resumption on Thursday. But the close of Friday is problematic. It's a doji candle, and it's a trading range. And after this, you can get anything. There's a doji candle. You can get the bulls coming in, and trying to find another one with the bears coming in. But the bears have not been terribly strong in this market. So I would not be selling beneath a bear doji on Monday if I'm trading the daily on pound versus the dollar. If you saw this on Thursday and you placed a sell order beneath here, a more aggressive stop would be above here. A conservative stop would be maybe above these two bear candles. That's perfectly fine. And if you did that and you saw the doji, you tighten your stop. If you took the trade with a stop here, because you trade in the daily time frame, there's no point unless you said become a bull candle. You're going to have to just hold it. That's part of the risk, and see what happens, what we get on the next day. If we get a bull candle, something like that, you can lower your stop down to above that, and hopefully the next day you might get resumption. But I would not be selling. I want to wait for a trend candle of any kind. It could be a high test candle like that, fantastic, or it could be another trend candle like that. If you do get that, then it's worthwhile to put in a sell order and then just manage your trade. I'll still keep a stop up here, jumping into any trades. But if your strategy says when you see that breakout, you're going to sell, well, fantastic. You just need to put the stop in the correct place. I don't like to sell beneath a doji because the doji is simply a trading range. You might get a failed breakout and get a big reversal up in that same day, or it might just fail completely. There's a doji. In fact, this is interesting actually. So bear candle, doji, huge bull reversal. Bear candle, doji, huge bull reversal. And that would have been a decent enough sell, as a high test candle. And you get the doji, you got to decide, do I keep my stop up here or do I tighten my stop? But that can happen because it's just trading range behavior. So you need to make your decision based on that. So if you'd gotten into the market below that, perfectly fine from my perspective. Now you got to make a decision. If you didn't tighten your stop, end of the day, that's fine. You just have to wait to see what happens tomorrow, and live with whatever the market gives you. Euro versus the dollar. Now, pound versus the dollar, we triggered a sell and closed beneath that previous low. Euro versus the dollar, we got a doji, but it didn't even get beneath the low of, didn't break beneath this previous low. Now, if you were trading this and saying, you probably had one of my strategies, break out, pull back, and I want to trade that. Fantastic. Conservative stop up there, aggressive stop up here. If you came to the euro and you thought, okay, I'm going to take that trade based on that breakout pullback, put the stop here, conservative stop up here, just above the bear candle, aggressive stop above here. When you get the doji, you're going to have to wait and see what we get and hold on to your stop and manage it appropriately. But I would not be initiating any new trades of the daily time frame tomorrow. I mean, if you're not in a trade, I wouldn't even bother. Look at this market until the end of the day to see what we got, whether the bears managed to close beneath that or not. So I wouldn't be selling beneath a doji. But as I said earlier on, if your strategy says, well, as long as it's a bear candle, I'm going to sell, then you need to be clear about where you put your stop. That's a more aggressive stop. That's a more conservative stop right up there. And then just manage what you get. So you got to decide whether you're prepared to sell beneath trading ranges. The only thing you have to be aware of. If you sell beneath trading ranges, most breakouts fail and come back. They may resume, but you got to be comfortable sitting through a failed breakout. If you're not comfortable to do that, like I'm not, just let it go until you see trends. Here's another one, huge bull candle. If you're going to sell beneath this doji, your stop is going to be up there. You don't put your stop there because it's just going to get stopped out very quickly. You put your stop at a key level of support and resistance. So that's, if you want to put a stop up there and hoping that at least for 1-to-1, market comes all the way down here, that's perfectly fine. But if you took that, just like I'm saying, I wouldn't take that particular one. But if you happen to say, well, I'm going to take that one, and you got that reward, then you got to pull your stop down, okay, to above that candle when you start to get this, because it might go sideways or go back. But trading range, price action, market is more bearish here. If you just where we started here, I don't have all the candles. We're a little bit lower in June, and that's a key low that is a target for the bears. The bears would like to get there and test that at least and see if they can break beneath this and then set up bearish price action for the rest of the calendar year, for the rest of the 6 months to come. But that's all depends. I mean, this week, you're going to have to watch. And, I can't say, well, I don't know what's going to happen. I can't say this whole week is going to be a trading range. You got to watch it day by day. If we end up with a bear candle closing beneath here, a trend candle, bear in mind, we are breaking out beneath the trading range and it might fail, but that could be a decent signal for you to take with the proviso in mind that the trading range breakout might fail. Then you put your stop, and if the next day it starts to fail, you tighten your stop. Okay. Gold, pretty interesting, after this dramatic bullish run that we had. We're just looking at the price action. Whatever drives it really doesn't matter. It can be anything that drives the market up or down. As a price action trader, I'm not really interested in what's driving the market up or down. There's just so many factors that do that, and I am happy to see price action on the charts. So we are in a trading range. Why would I say it's huge? Or rather, probably the correct word is we are in a prolonged trading range. Since getting to these levels here, the 2,400 level, somewhere in here, tried to get higher, failed. Bulls have defended the market dropping lower than the 2,270 level. And bears have prevented the market from getting any higher. Now, what is interesting about this, I'm not an MT4, so I really can't show it higher. But from a bearish perspective, that's the height of the trading range. Oops, I don't need this. That's the height of the trading range. And the bears are probably salivating and saying, oh, if we can break beneath this trading range, if we can break out beneath this trading range, then we can start to push the market back to the 2000 levels, 2067, etc. That's a crystal clear price action outcome that the market, the bears would like to break out beneath this and take $270 off the price of gold. Now, if we kind of project it upwards, if we had enough space, the bulls would be saying, well, If we can break above this trading range, we can put a measured move up and add another 270 bucks, you know, to the market, basically. And if they do that, I mean, I'm even hesitant to think uh, what would force the market to go there. That's why I don't worry about it. I just want to wait to see. If we start to see a breakout, moment you start to say, my goodness, let me go in as a price. Okay, let's just rephrase. As a price action trader, if I start to worry about the fundamentals, I'll never trade because then I have to start doing research to say we are breaking out above here. Is it possible that gold can go up any higher from where it is? Now, moment I start to do that, because I'm gonna say, well, this is what is 2274, this is 2443, 170 bucks, whatever it may be. Is it possible that gold can get to 26, even 25, pretty close to 6? Can we get to that? I'm not interested. I'm not worried about what can drive it. If I see a breakout, like let's say we were here, as a price action trader, if I see a breakout, I'm going to trade. I'm not going to try and understand what's causing the market to go up. I'm just going to trade it. So if I see the bulls coming back into the market and we start to break out above that, then you must just buy. Put your appropriate stop. If you're buying on the daily, put your stop beneath the trading range and then just hold it. Okay. Get a big breakout. You're assuming you're going to get a measured move, so you can manage your stop, put your stop down here. Now, what is likely to happen from the price action that we are seeing? We had this huge bear candle here. And since then, the bulls have tried to come back to test its high. They have failed. Decent enough, strong enough reversal here on Friday. Now, if the bears are strong, they want to continue the selling price action and get beneath this low. I mean, it can happen in a day. I mean, they could put a candle like that, a candle like that. That's a bears, that is. They could put one or two candles, put one candle on Monday that completely erases these lows and breaks beneath the low of the trading range. Our trading range is a little bit tighter. Okay, no worry about it for now. But you'd have to mark it beneath this low. So just maybe another 20 bucks or so off. But the bears can easily do that. And if they do that and they start to sell off and give us another follow through, then that target is likely 2067, starting to get into 2000 level. Would I sell on Monday if I was a daily trader on gold? Yeah, I would sell here if I wanted, but I'll put my stop up here. That's a conservative stop. That's an aggressive stop. Sorry. If you wanted, what is he saying? What is this guy saying? I'll correct it just now. Two places you can put your stop, and we'll see who's more aggressive and who's not. Okay, there's a 2-bar reversal. There's a measured move. That's the conservative stop. Right up here, measured move of the pattern. Aggressive stop is here. Okay, so if you want to trade gold, you trade the daily chart and you're going off somewhere not going to be in the market. As soon as it opens, place an order beneath here, put your stop above here, and come back and see if the bears are strong enough to sell off and start to accelerate down. If they fail within one day, that stop can be taken out. So if you're not comfortable with the tighter stop, use the measured move stop. So when you come back, if they trigger and it fails and say, oops, wrong, I'm getting out, you save half the risk. But in my view, based on the price action, from this high that we've had, I don't have any other information here, but high of the year, let's use that. bear breakout, pull back. This is a lower high to that. Bulls had a chance, they failed quite dramatically. And we put another lower high. So the bears have a chance just to start to sell off a little bit more. So the probabilities favor the bears on gold. Finally, across now, I mean, you could look at many markets. So what I'm trying to demonstrate is just the thinking for you to look at. Just look at, if you ever look at the market, if you ever look at this whole market, where would you have wanted to be in the market? Probably would have wanted to be in here, beautiful bull trend, bear trend, beautiful bull trend. But all of this is just sideways price action, trading range price action. Unless you are scalping in and out of the market, do not do anything on the daily chart on Aussie CAD or any market that is in such a trading range. You want to wait for clear breakouts for you to trade. If you know how to trade with limit orders, you can trade the trading range. Fail breakout, you sell back into the trading range, and hopefully it gets down here. Then you can buy and bring it up if you trade that way. But if you're looking for trends, then it's probably best to wait for the market to break out beneath the low or above the high. All right, guys, this is me for this week's update. My hope is that you can use the information, the way I've looked at the markets, to kind of review your own charts for the week. I've used the daily time frame. Now, price action is price action because these patterns are fractal. The same thinking you can apply to any time frame. What is interesting is I did not put any EMAs on the market, exponential moving averages on the charts. I just looked at price action purely. Hopefully, you find that interesting. We shall catch up again. Name is George right here. We'll catch up again. Take care, everybody, and have a